You're often referred to as the father of SIPs in India because that's a concept that you really helped popularize back in the 90s. Why you think SIPs are still a great way for a regular person to build wealth?
There was just a eureka moment where I saw that if I do, let's say, save 1,000 rupees, right, for 30 years. So your total savings is about 3,60,000. But at 18%, it compounds to a crore.
What advice would you give someone who's already in this active senior phase, but they haven't really given any thought or done any retirement planning at all?
Having a formal roadmap is fairly important. If you have really done no thinking, then I think you still have 45, 40, 50 years to go ahead. So it's never too late to start.
What's your take on succession planning?
The earlier you talk about succession planning, the better it is. I always believe start by saying that I want to transmit the real wealth of my money that I've generated.
For active seniors, gold and property, these are the best investments.
So I feel a good portfolio should have good weightages not only on your physical assets but also on financial assets. And that could come through deposits, it could come through insurance products, it could come through any other financial asset for that matter. So yeah, it's a myth to think that gold and real estate is good enough.
Over the recent years, at least, you've shifted your focus to more around retirement planning and financial planning for people who we will call active seniors.
It's called the 3-bucket theory, that you spend all your assets in 3 different buckets. The short-term bucket is where you withdraw your money for, so it's less volatile. And the longest bucket is...
Hi everybody, welcome to another episode of the Meru Life Podcast. This is the one podcast where we discuss everything that you as an active senior care about. Whether it's your physical health, your mental health, emotional health, financial health, and everything else under the sun. My name is Mihir Karkare. I'm the co-founder and CEO of Meru Life, which is a first of its kind ecosystem designed to help active seniors like you live an active, connected, and purposeful second innings. Today, the topic we're going to cover is a topic we've been asked about many times. It's about financial security and financial planning after the age of 55. And to talk to us about this, I have possibly the best guest I could think of, Mr. Suraj Kaeley. Surajji started his career at HDFC. After that, he spent over 2 decades building and leading teams across the best Indian and global organizations, including the likes of MetLife Insurance, Franklin Templeton, Fidelity, and UTI. Today, he is a mentor to Autium Financial Services, which is a mutual fund distributorship based out of Mumbai. He's someone who's very passionate about personal finance and specifically does a lot of work in the area of retirement finances, which is why I thought when it comes to finances of active seniors, Suraj would be the perfect person to join us today. Suraj, welcome to the Meru Life Podcast.
Thanks very much, Meher, for this introduction. It is such a pleasure. And in fact, I love that word, active seniors, because I feel that is also the secret, to a very purposeful and a meaningful life.
Right.
So it's my pleasure to be with you today.
Thank you so much, Suraj. Suraj, what we define as active seniors are people who are in the age group of 55 to 70 and people who have aspirations of their own, who have desires that they want to fulfill, who have interests and hobbies that they want to pursue. And we want to empower them in order to do those things. And I think financial security and financial planning plays such an important role here. So I'm very excited to have you again, and let's get started.
Sure.
Suraj, obviously your professional journey has been, really inspiring. We met probably just pre-COVID and you were like a mentor to me. And this is something which I've always looked up to. But I'd like to go back right to the beginning. How did your career get started? How did you enter this industry, this domain? I'd love to hear that.
Yeah, Mihir, when I really look back, I see there's a big change in the way we used to think about our careers, right? Those days, you never really applied your mind saying what you want to do and how you want to do it. It was about whatever breaks you get, you take it in life and take it forward. I was very fortunate that, when I finished my MMS from University of Mumbai, I got picked by HDFC Limited as a management trainee. Right. And luckily for me, maybe I later on discovered that that's the area it's so close to my heart. And I was just at the right place, at the right time. Then, of course, after working with them for almost about 7 years, I realized that my love for capital markets is quite huge. I actually joined a broking firm on Bombay Stock Exchange for a very brief period. And then, as it would happen those days, the firm got acquired by, or the firm was to acquire another firm, or rather, let me put it this way, that the plans that this firm had, they didn't materialize the way we had planned out.
Right.
And that's where I landed up with Franklin Templeton. I was the 8th employee to join them in 1996. Asset management was a bad word. It's not like the current days where we say mutual fund sahi hai. In fact, I still remember my father-in-law was so upset that I joined a asset management business.
Right.
But luckily for me, it all worked out. I then worked with them for several years. And that's where, I discovered this concept of SIPs. Today it's a household name. So it was a very exciting time in my life because I found that there was something all of us could really do in terms of personal finances to enrich ourselves. The career just kept on building from there, and I then moved on to MetLife for some time, and I got great exposure to life insurance, building that business there for almost 4 years. In fact, that also gave me an opportunity to learn, build and very large teams.
Right.
So my team size itself was over 1,200 at that point in time. So I really learned a lot about managing people in that particular role. And from there on, I came back, joined Fidelity. I worked with them till they sold out the business in 2012. And my last role was with UTI. So somewhere around 2019, I decided that enough of corporate life and just move on from there. So that's how my journey has been so far.
That's very interesting. So the start was like serendipity. You ended up being in
Absolutely.
HDFC, but beyond that, you seem to have found your true calling in this domain, which is really, really good to hear. You got into leadership position at these great organizations, and then you took a decision, very conscious decision, to move on and venture out on your own, perhaps at the peak of your career. I'd really love to understand, the thought process behind doing that. It'll be good for everybody to hear. Yeah.
No, this is a wonderful question because, what I realized is I think most of us, when you're around, let's say 45, 50, you start thinking about that, someday your career will end, right? And probably that is the time when you're at the peak of your capabilities. And I used to always think that, okay, after retirement, what? Because retirement is something which is very unique to somebody who's working in organizations because they have to find something to do for themselves later on. It was around that time, you start asking some very fundamental questions about retirement, like how much copper should I have? What would I do after in my retirement? Most of us take different paths. Some of us may say that, look, I want to do nothing and just relax and chill.
Right.
I've done enough in my life. Some of us may actually want to pursue our passions because you've never done that
Right.
in your career. Luckily for me, that was never the case. Whatever I did, I always enjoyed doing it. But one thought which really got triggered was that I started realizing that life after retirement is almost maybe bigger than your working life. So for example, if you start working at 25 and retire at 55, and because of the longevity revolution that's going on,
Right.
you may live till age 100. So just imagine you've got 45 years more. And I used to wonder, what will I do? So I couldn't really visualize sitting, watching TV or going just on holidays. And so I realized that I have to make some transition. And I also realized the fact that if I actually, don't give up my corporate life, it's like crossing a bank of a river. Till I don't give up this bank, I won't be on the other side.
Right.
So my calculation was that if I retire at 58 or 60, which normally most of us do at that age, maybe at that time you're not left with enough strength and desire to do something because financially you will become more stronger. And so I realized that that could actually be a trap. And that's the reason, maybe 5 to 7 years before my normal retirement. And it was not an easy decision. Let me tell you
Sure.
that. It's something which I was always reflecting. There's a lot of money that you leave on the table when you do something like that. But today, as I look back, I think that was the best moment of my life to just say, okay, let's move on and do something that you care for. And even in Indian mythology, for example, there is this concept called Vanprasth. Right. So the concept is very simple that, so when you eventually give up your life, before that, there's a phase where you are supposed to return everything that you have back to society. Right. And so that was also one of the triggers. I felt that, okay, I've got a lot of learnings in my life, especially in personal finances. And I think I can help millions of people in that space. So I thought it was just the right thing to do. And the best part is that Now, when you do something, you don't have this pressure of closing a deal or
Right.
there's a target. You can lead your life on your own terms, which doesn't happen in the corporate world as much. So that's how my decision happened to move on at that age.
I must say it's a very brave decision. Like you said, the first thing that someone would think about, like even when I hear about this decision, is you must have left a lot of money on the table. That's the first thought that comes to mind. But having this clarity of thought that, I'm entering into a phase where I'd like to do things on my own terms, it's absolutely fascinating. Thanks for sharing. I think it's a very personal story. Suraj, you're often referred to as the father of SIPs in India because that's a concept that you really help popularize back in the 90s, if I remember correctly. Do you want to talk a little bit about that and why you think SIPs are still a great way for a regular person to build wealth?
So that again came from my desire to, my interest in personal finances. India is a socialist country. And when I look back at that point in my career, anybody who had made wealth, we used to feel that they would have done something wrong in their life
Right.
to get the kind of wealth they have,
absolutely.
right? And I always used to think that, okay, how can the Indian middle class, I was one of them, right, who's aspirational, wants to generate a lot of wealth, do it in the right way. And interestingly, the way it happened was I used to work for HDFC and I used to work in the deposits department for some time. And I had created a product there called Easy Way Savings.
Okay.
Right. It didn't succeed as much at that point in time, but essentially the concept was that it was a great substitute to a recurring deposit.
Okay.
And so typically, because of regulatory reasons, we could only offer that product with a 7-year tenure. But luckily, the interest rates were very high those days. Today, when I tell people that we used to offer 15%, they get shocked.
Wow.
But yeah, you could save a meaningful chunk, at that point in time for 7 years and get that kind of a return. Inflation also in India was pretty high at that time. So when I joined Templeton, I was just playing with some Excel sheet and seeing, okay, what would happen if, for example, you generate, let's say, 18%. And because obviously the deposit rates were high, the Sensex, by the way, had delivered a similar return of 18-20 at that point in time. So those high numbers were not like, that's what market
They were not
talk
unheard
about.
of.
They were not
Yeah.
seen as high
Yeah.
as they're seen
Yeah.
today.
Yeah.
And there was just a eureka moment where I saw that if I do, let's say, save 1,000 rupees, right, for 30 years. So your total savings is about 3,60,000. But at 18%, it compounds to a crore.
Oh.
Right. And typically I realize that stock markets do have the capacity to deliver that kind of a number, because if any firm is raising money from the market, you need to deliver superior to debt at least to begin with.
Absolutely.
And that's what the source of SIP was. And I realized that actually you can mint tons of money by just this habit of saving regularly.
Right.
And of course, over time we learned. So SIP, what it typically does is it allows you to buy into a fund. Fund is a diversified portfolio. So it doesn't only work in one condition if you're on a secular way down. So stock markets generally are seen as something which are on a secular way up. So they may have their bumps. In fact, corrections can be as deep as 40-50% at times. But if you keep a longer term horizon, right, it tends to pay out in your favor.
Right.
So that's how the SIP thing got discovered. And I sold this to my competitors as well, all my friends. And of course, Indian capital markets reformed. We had digital technology that came in. So you didn't have to write 60 checks. I don't think so. You would have seen this kind of growth if all those things would not have happened.
Right.
But a lot of credit I would give to SEBI as well, because they really built in very stringent regulations on the asset management side. And I would say that Mutual Fund Sahi as a campaign also was a great thing which happened to the industry. So today SIP is seen as a great part. But yeah, when I started, it wasn't the case, by the way.
I'm sure it's very gratifying to see where it's taken investors and all of that, right? Like there's such amazing stories to hear. Must be very gratifying, I'm sure.
Oh, absolutely. I think it's the most satisfying part of my life when I look at my own career.
That's amazing. And so while SIP was, something that you worked on in that phase, over the recent years, at least you've shifted your focus to more around retirement planning and financial planning for people who we will call active seniors for the purpose of this discussion. Can you tell me how you kind of made that shift and some learnings from the work you've done here?
Well, no, I mentioned to you that I decided to give up my corporate life at age 54. right? And so that's the first time I started reflecting on this subject in a big way.
Right.
And as you would normally do, you would research the web, you'll ask your friends, your colleagues. I know so many fund managers, and we used to have discussions on this subject. And interestingly, what I found was that all the literature points only towards savings on a regular basis. So how you create your retirement corpus.
Right.
And I was just thinking that, okay, yes, I have got my corpus, but how do I deploy over the next 45 years? There was just no literature. So I had come across things like the 4% rule. For example, whatever corpus you have, you just withdraw 4% every year from there and meet your expenses, whatever they may be. But that also has an underlying assumption of 60% of investment in stock markets through equities,
Right.
which I used to feel intuitively is too high an allocation at that age. So I realized that this was also borrowed from the US. And in the
Right.
US, what typically happens is you have social security, right? So to that extent, if you were to take a little greater risk on the money that you have, you know that your pension is coming in a way from the government, right? So I realized that could not be just deployed in Indian conditions. Then I'd also come across what is called the 3-bucket theory, that you spread all your assets in 3 different buckets. The short-term bucket is where you withdraw your money for, so it's less volatile, and the longest bucket is into equities.
Right.
But again, as I would reflect, when I'm making a transition from one bucket to the other and the markets are not in my favor. So as I dwelled more on this subject, I started realizing that there's a big need, for this transitioning to retirement. Right. Because what happens is most of us believe that, you just recast your portfolio on retirement and you're done.
Right.
And I don't think so that's the approach one should take. So when you talk of active seniors, for example, I think the biggest challenge for active seniors is exactly what I went through, that how do I make that transition?
Right.
And as I spent more time reflecting, I realized whatever I had learned, I had to unlearn all over again. So the biggest challenge what I saw was that as you get to that age of 50, 55, you have now 20, 30 years of investing experience that is backing you. Right. And by the way, that also leads to biases in your mind. So, for example, if you have made money in equities like I have done, chances are I'll have a lot of money in the equity side. But that's not right for retirement. I have to reduce the exposure to equities. I've seen a lot of my friends, they benefited a lot by investing in real estate. So they all are very asset heavy, but liquidity light.
Right.
They just don't have day-to-day money as much as they would desire. But when you look at their assets, they are locked into real estate in a big way. And I'm not sure if real estate would give you similar returns going forward.
Right.
But so that bias will again come and hit you. So now if you really got caught out in the Harshad Mehta scam, or you lost money in 2008 in the global financial crisis, you'll swear not to invest in equities, which again is the wrong thing, because then inflation comes and hits you. So as I reflected on this subject, I realized that, there are these biases that come in. There are 45 years is a long time frame. You're going to experience things which you have never done in your life. For example, we've not seen big wars over the last 60, 70 years. So today also we talk about the Second World War, which happened in 1934.
Right.
But what prevents a Third World War? We don't know. Right. So in the next 40, 45 years, if you're going to survive, you're going to see events which you never visualized. And one of them happened just recently, like COVID. Absolutely. Nobody had thought that, there'll be a lockdown and you'll be stuck at home for 15 days, and then that kept on getting extended. So I realized that you need some more dynamism, you need some more insight. And that's where I committed that, look, I think as India ages, maybe I can, again, what I did in the SIP side of the story, can I do a similar thing on retirement finances? So that's where my subject really I got very interested in that subject. I've done tons of reading on that subject. And interestingly, as I've done that, I've realized that finance is the least of challenges. The other challenges in life and retirement are far greater, and they have a very deep impact on your retirement finances, by the way. They are very intertwined.
Right.
So that's how it all happened. And I've been just doing a lot of work in that area. And I'm excited to share whatever little I've learned in that subject.
No, absolutely. This is fantastic. So, just to, the recap of this journey is very fascinating. So starting out as a management trainee at HDFC to building such a phenomenal career and, SIPs along the way, and then taking a conscious call to make a shift in your own life and also make a shift in your area of focus, from focusing on SIPs to focusing on retirement planning. I think absolutely very fascinating journey. Like I just mentioned some time back, I cannot think of a better person than you, to talk to active seniors about retirement planning and retirement finances. So, Suraj, with that in mind, maybe we can shift to this specific topic. When you talk to an active senior today, what do you think are the major challenges that they face when it comes to thinking about retirement planning? I'd love to hear what your take is on that. Yeah.
Well, you actually answered it in a way in your question that actually people don't think about retirement finances.
Right.
My own experience is that very few of us really give it the thought, which is required. So, and it's not easy because, when you're thinking of investing for retirement, there are so many uncertainties. You don't know the lifestyle you want to lead. You don't know how your health will shape up. You don't know how long you'll live fundamentally. So longevity itself is a big issue. You don't know what markets conditions will throw at you. So for example, in the Western world, we had zero interest rates for a very long time.
Right.
Nobody would have visualized something like that. You may see very steep corrections like in 2009. So everything is an assumption. And it becomes so daunting that people actually avoid that question. They don't really go down the path of asking those very serious questions. And fundamentally, it also stems from the fact that to think about what is the purpose of my life. All those questions are also coming at the same time. So I think when it comes to retirement planning, I don't think so it is something which people spend enough time thinking about. And I think that's really, the thing that you have to address fundamentally. And as you go down that path, you start realizing that actually there are 4 buckets in which all your problems can be defined, right?
Okay.
The first bucket I would say is longevity, because till what age should you be planning for? So just to give you one stat, I read in one of the books, any child born today in the Western world, in Canada for example, has a life expectancy of 107 years.
Wow.
Right. So you can imagine that if you're working till age, and people want to retire early, right? So imagine you retire at 40
Right.
and now you live 75 years. I don't think so the same retirement concept will really work.
Absolutely.
What the way we define it in today's day and age. So longevity is a starting point of that question. The second bucket I would say is the economic and market conditions, right? And again, when you look at examples there, I mentioned about very low interest rates. I have seen that in my own life. So I mentioned to you that in 98, 99, you would get, let's say, 15% on your deposits. But today, when you renew those deposits, you're getting 6. So just imagine if somebody had visualized that I'll earn 15% for the rest of my life. They will be in very bad shape because interest rates have come down dramatically. Then that also covers taxation, because taxation rules keep changing. So the impact it has on your finances can be pretty large. So again, I would say that market and economic conditions are a big part when you're thinking about it as a challenge. Then comes the next big thing, which is your health. Because now if you have just age-related ailments like, let's say, diabetes or blood pressure, and you pop a pill and life goes on, that's easier to manage. But if there is something which disrupts your life completely, it will also disrupt your finances, right? So again, that becomes a challenge and very difficult to say, okay, how much money would you really need if something like that happens? So you have to, start thinking deeply about it. And of course, you will then go down to the path of avoiding all that by hopefully maintaining a better lifestyle. But there are no guarantees, right? So you have to budget for even health as one of the subject. And then the last part, which I would say, is succession, legacy.
Right.
I always believe that if you've worked so hard in your life to make your wealth, you want to ensure it passes on to the next generation in a meaningful way. Now, philosophically, you can say, look, I am not around, so how does it matter? So again, nothing wrong with it. But I would say that, why not spend some time and at least pass it on to an organization or your family who you think will make good use of it and carry those legacy forward. So I would say that when you talk of retirement finances, you're talking of all these subjects. Right. And but as I mentioned, this is the smaller part of life than the fact that you talk about your physical health, mental health, emotional health. And that's why I love Meru Life, because the fact that you're doing a great service to the active senior, segment, because they really need something which brings alive these discussions, and through those discussions you learn. At this age, you don't want to enter into a classroom and you'll be talking to your friends, and I think Meru Life can be a great friend
Right.
So I've always been excited about what you've been doing because of that reason. I think that's the way I look at retirement finances as well. So there are
Right.
some very specific aspects and you can deal with it as well.
Got it. No, thanks, Suraj, and of course, thanks as always for the vote of confidence. So, Suraj, this may actually be a rare occurrence, but what advice would you give someone who's already in this active senior phase, so probably 55 plus, but they haven't really given any thought or done any retirement planning at all? How do they navigate from here on?
Well, first of all, let me say that this is not a rare occurrence, right?
Okay.
So when you say that somebody has not done any planning, what generally it means is they may not have formally reflected on that subject. But in the subconscious, they do have some thoughts in mind. They do have a belief, that how they are going to lead their life in retirement, right? So what I'm really trying to highlight here, is that your intuition, your thoughts, or whatever kind of informal plans that you've built, it could be things like maybe you want to live off, especially North India, I've seen this, you'll construct a G+1 structure, and the first floor you give on rent and ground floor is where you survive, and you are getting some pension as well. Now that's not a bad retirement plan, right? Because I think it's quite sound in many ways. But yeah, they may never have done a very formal kind of planning at that point in time. So what I really try to highlight here is that actually, income generation is just one of the variables.
Okay.
The reality is that there are many other aspects, like I mentioned about, let's say, medical health, right? So many other things that come along the way. Maybe, there could be a period your house doesn't go for rent for 2 years. You never know what things can go wrong. So what I always highlight is that having a formal roadmap built for yourself is what really I feel is fairly important. That can serve a lot more value. But in reality, yes, if you have really done no thinking, then I think you still have 45, 40, 50 years to go ahead. So it's never too late to start. So that's what I would recommend to most of them. Yeah.
And Suraj, what in your opinion are the constituents of a good retirement plan? What all does it include?
Yeah, so basically, when you start building your retirement roadmap, you're not starting at the point where you are already retired. You start a little bit earlier. Right. So typically the way, people think about retirement is that in the very basic stage when you're young, you're starting your careers. That may be the right time to save for the long term, but nobody does it with respect to retirement. Then around 35 to 40 years is the first time, when you really think seriously about retirement. Now, this is a stage where, for example, you may have some young kids, and nowadays there's the IPL season going on, so people go and play cricket matches. You come home and now your body doesn't recover. So when you were 28, 30, 25, your body would recover. You never even think about it. But suddenly you realize, oh, my bowling arm is still painful. And then you start realizing, oh, I'll get older, so I must do something about retirement. Now, at that stage, what you do is you just want to get started. So, and you don't really give enough thought to what you want to buy and how you want to really, plan for retirement. I think the serious thinking happens, at somewhere around 45, 50. Right. And then there's a phase which lasts till the day you retire. So I call this transitioning to retirement. Right. That's the time you really start working on it, and then you finally retire. So now when you're building your plans around it, the most fundamental, or where you start your journey, is defining what is the lifestyle you'll lead, because that is where you compute your regular expenses. Right. And there's a fundamental shift in the way you will spend in your retirement. Some of them may actually spend more in retirement, and some of them may spend much lesser than what they are spending currently. But I've seen that you just make an assumption and you start. That's not the way to do it. So you have to spend time figuring out what kind of expenses you will have. That's the fulcrum on which the whole retirement journey is built around. Then you make certain assumptions on inflation, because we don't know how prices will move. Currently 4 to 5% may seem reasonable, but who knows, India becomes very developed and then 2 to 3% also could be okay. Or we struggle, there's a global crisis and interest rates and inflation go to 10% plus. So inflation is the next big part that you have to make an assumption on. Then what kind of investment returns you're likely to make on your investments. Again, that's very personal to each individual, because taxation for each individual is very different. So that is the third component that you will build on. And obviously you're trying to ensure that this money lasts your lifetime, so you start with an assumption about longevity as well. So now it's an interplay of all these elements, and as you go about building it. And as I mentioned that when you're transitioning to retirement, maybe you've not even created an adequate corpus. So how much you need to save and what kind of returns you will generate on that savings, so that your retirement corpus is adequate, that also should get captured as you build this plan. So the various elements really are revolving around these factors of regular savings, the investment return you're likely to generate, inflation, expenses, the investment return on your retirement portfolio, and longevity.
Right. Firstly, it's not a one size fits all thing. That's what I can understand. And even within the plan itself, there are 4 or 5 interplaying things that are there.
That's right.
I can imagine this topic being something that our audience, our active seniors would want to do a much larger deep dive in. So that's something for us to take up on another day. I think one specific point that I wanted to also talk about is, medical emergencies. Because the likelihood that someone may face a medical emergency increases after a certain age. And that medical emergency is not just going to impact them like their physical health, but it will also impact their finances. So how does one prepare for that eventuality?
So as I mentioned a little earlier as well, that when you think of medical costs, right, it is something which is completely unpredictable, right? And the starting point of that journey always is that, okay, what is your current health condition? Because if you know that you have some kind of a predisposition or maybe a family history, then I think you can do a little better plan for yourself than otherwise. So for example, if you have a family history of heart attacks, right, then you can cover, take medical insurances which specifically cover the risk associated with heart, right? So today what happens is when you're going into the market to buy any of the medical products, right, being aware of where you currently stand, is very, very important. So when, for example, you're trying to buy health insurance, there are a lot of diseases which are pre-existing, are not covered for a period of time, and many people are not even aware of it, right? So typically the way I think about it is that there are 2-3 key elements of that planning in, for your health challenges. Insurance, of course, is the very bedrock on which you build it. But more importantly, you must realize that when you land up in a hospital, right, they may demand some money upfront. So I generally prefer to have credit cards with good limits, right? So if there's a problem, I'm not really trying to struggle with that emergency. Oh, did my health insurance approve it? You land up at the hospital, you can swipe your card, and at least now you have 40 days to repay that money.
Right.
My second belief is that typically when you buy medical insurance, the cost of that insurance keeps going up with age.
Right. Absolutely.
Right. And typically all of us will buy a fixed amount. So somebody will say, oh, I got a cover of 50 lakhs or 1 crore, whatever you're bought in. But reality is inflation will keep reducing the cover. Right. So if you have the same cover 20 years down the line, that will be inadequate.
Right.
So which means that you need to create some emergency funds as well, which are earmarked and not meant for your other expenses. So I always insist that put some amount separately and say that, look, I'll just keep this going and I will only use it if there's a medical emergency. Now, it depends on how much you can afford, but some amount which is kept distinctly. And the other advantage you get is that if a particular procedure is not covered by, let's say, the insurance policy, you can use this amount in that basis. So there's a lot of thinking that goes in as you even plan for your medical risks. So, and these are just some key elements where you start building your medical plans.
Right. I think somewhere knowing at the back of your mind that your financial well-being is secure, even in the eventuality of a medical risk, I think that can actually go a long way in helping people even recover faster. I think that's a topic which is not discussed very often.
Absolutely.
Actually, another topic which is similar, which doesn't really, people skirt around the issue in India at least, is succession planning. What's your take on succession planning? How should seniors look at it? When is the right time to talk about it? Would love to hear your perspective on that as well.
Well, honestly, all my life I've advocated that the earlier you talk about succession planning, the better it is. Because
Right.
ultimately, we know life is uncertain. Right? To say that only I have to do for my retirement is not a great idea. And having said that, I know of so many professionals, who are in the law field, for example, right? They also don't do their own wills, though they are from that
Wow.
profession. They don't really think about it, how these assets will get passed on. So when I think of succession planning, I think in two dimensions. The first dimension is that whatever wealth you have, you want to ensure it passes on to the next generation in real value. So in other words, for example, if your retirement corpus is 5 crores as an example,
Right.
and you'll survive the next 30 years. Now, if after 30 years you still have 5, its value is only 1, because 80% has got away because of inflation. So when you think of succession, I always believe start by saying that I want to transmit the real wealth of my money that I've generated. Now, when I have these conversations with a lot of our clients and otherwise, I've seen it's a very philosophical question, because I know so many of them. They tell me that why bother? I'm not around,
Right.
right? And I don't think so. That's a great approach, because you put so much of your effort to get there, and the incremental effort is not that large. When you do your succession plan, so typically the least you start is, if you have financial assets, you must ensure nominations, because so I have seen so many people, they just don't have nominations. And even I have experienced one, that's with one of my aunts. When
Right.
she passed away, she wanted to give that money to me, but all her FDs had no nominations. And luckily I was in the financial services sector, I could still get the money, but would have been very challenging otherwise,
Right.
right? So
I'm
so I
sure.
think it starts with very simple things like ensuring nominations, simple things like joint ownership. So, for example, if you have a home, I've seen a lot of people, take it in single name, right? But then it becomes an issue. So, if you jointly own it with your spouse or whoever
Yeah.
is significant in your life, I think that's a great way to ensure that the asset passes on to somebody else. And then eventually you get to the stage of writing a will, because that just simplifies the process in case you're not around. So, and it's very easy then to execute that and take it forward. But if you don't have that, you should ask people who have gone through conversations on that subject. Of course, you will face challenges in answering questions, like I've got 2 kids, and when I'm thinking of my own passing on this legacy to my family, I've been also thinking, Acha, what should I give it to my son? What should I give it to my daughter? These are very
Right.
straightforward questions.
Right.
You also have to budget in your mind that, okay, if you're not around, then how does your spouse survive well? Because women live longer than men. So you also have this period where the money is not going to anybody else. You want to do it not after you, when you have gone, but after your spouse is also no more. So again, so there are very challenging questions to answer, and that's why people avoid it at times. But I would say that you have done a great job for yourself if you have ensured that the money reaches the right hands.
Right.
And if you don't want to give it to your family, you want to give it to charity, it can be to anything. You can actually, there are mechanisms in Indian law which give you so many opportunities of passing on this wealth to the next generation. And luckily in India, we don't have estate taxes.
Right.
I'm sure as India gets wealthier, estate taxes will also come through. So you'll see that part of it has to be shared with the government
State.
as well in any case till you acquire assets. So take advantage of not having those today, and see, how well you can build a legacy and leave something meaningful behind for the other world as well.
Right. So I think what you're saying is that, it's like making a choice between having someone else figure things out after you leave, or facilitating that while you're
Absolutely.
here. And I think,
Absolutely.
apart from leaving something back, also saving them from the hassle, because many of these things, they are not always as straightforward and as, peaceful, if you don't plan these things. So I can, apart from the asset you're leaving behind, you're also giving the gift of peace of mind, I
That's
think.
right. I always say that it matters to me what people think of me when I'm no more.
Right.
So, for many, it may not, but I
Right.
think you want people to remember you for good things. And
Right.
when you give something to others, even when you're living, it's
Right.
always a great feeling, right? So I think, why should you give up that opportunity when whatever you've created in your life, you pass on to the next generation?
Right. Got it. Last question. You probably touched upon this very briefly, but I want to deep dive. Today, when we look at active seniors of today, what we see is that women have probably had a slightly different life trajectory compared to men. So you might have women who've taken a career break, or maybe they've been homemakers. So their trajectory has been different compared to their male counterparts. How should they think about retirement planning? I mean, maybe in some cases it's not exactly retirement planning, it's planning of their finances after the age of 55. How should they go about that? What would be your feedback on this question?
Yeah, so before I get on to the differences, right, I certainly first of all want to celebrate the fact that women are, I call them the finance ministers of home.
Right.
You look at any home in our country, if any time there's a financial crisis, some magical money comes out of somewhere, and it's always the women who bails you out, right? Similarly, what you would see that women are very disciplined and consistent investors. So there are a lot of studies which show that, right? So I do believe that first of all, women naturally, invest much better than men in many ways. But having said that, there are a lot of differences, some of which you have alluded. The fundamental difference is longevity. Right. So because women tend to live longer than men, right? Then comes the point that women take, because of various reasons, career breaks, right? So especially in India, you will see that even when, let's say, one of your parent is not doing well, you'll give up your career and say, okay, let me take care of the family. So they always prioritize family over, other important things in life. Third, women, we have had these studies where there is a income pay parity challenges. Of course, it's getting over quite a bit, but the reality is that because of those reasons, if women can start to save earlier and save more consistently, it can make a big difference. And women typically, as I mentioned, are more disciplined and long-term investors. So I feel that their ability to transform savings into wealth is far greater than even men to that extent. But obviously you need to cover all these aspects, especially if you are a women active senior. And I feel that one of the big elements I always keep highlighting is that ultimately the entire wealth which will get passed on to the next generation, and if statistics prove us right that women live longer than men, then your own understanding of the financial world becomes fairly important. So you don't have to become Einstein at trying to know every aspect of investing, but the very basics of how do you buy or sell any instrument, what are the inherent basic risks, what are the precautions you should take. And these are very commonsensical ways of, answering. And getting involved in the home finances and assets, a little earlier on, I think can make a big difference when it comes to women active seniors in particular.
Right. Got it. Awesome. Suraj, thank you so much for sharing your perspective on so many topics that we discussed. Now, let's come to a very popular segment. We call it Mythbusters. And what I'll do is I'll ask you some myths, or I'll say some statements. You can bust that myth, or maybe even tell me the myth. It's not a myth. It's correct, right? So whichever the case may be. तो मैं कुछ beliefs या myths बोलूँगा. You have to tell me your reaction on that, right?
Of course.
First statement. Retirement के बाद investment planning की ज़रूरत नहीं होती है.
Well, I think that is the biggest myth which has to be busted. In fact, you need more amount of planning after retirement. I think this habit of saying that, okay, I have cast my portfolio once and I'm done, I think that's not a great thought. I have mentioned earlier that there will be so many changes in your life, so many changes in market and economic conditions. And if you don't really have a retirement roadmap, you will really not get there. In fact, you must remember that now you don't have a second chance in many cases, right? So when you're working, some money you are still generating, you will not have that chance again. So I feel, having a retirement plan post-retirement is maybe more important than actually building it as you are thinking about retirement.
Okay. Fixed deposits are the best and safest investment for active seniors.
Well, this is again the biggest of myth. So let me give you one simple example. So fixed deposits, when you buy, you typically will buy for terms of 5 to 7 years. Right now, just imagine 5 years later when interest rates will be very different, and I won't be surprised like what people in the West discovered. They were earning 3.5% earlier, and then the interest went to 0. So where is it fixed? Fixed is only in your mind.
Right. And in the name.
Yeah. The second point is that, so let's take another example. There's a family which, let's say, has 1 crore, and now they're getting 7% as their interest. So they are earning 7 lakhs. And today, if you ask them, is 7 lakhs sufficient? They may say that, yeah, this is more than sufficient. Our expenses are only about 4.5 lakhs. In fact, we're doing very well. Now, just fast forward 20 years from now, right? What do you think will that 7 lakh buy after 20 years, right? It may buy only 25% of the goods you're buying today because inflation would have eaten into the purchasing power.
Absolutely.
Again, it's not the money that you get which has to be fixed. The fixed amount has to be in real terms. You should be able to buy the goods and services that you otherwise would buy normally, right? Which is unpredictable because inflation is unknown in the whole picture. So I think the biggest myth that goes around is the fact of investing in bonds and fixed deposits, thinking that, oh, I'm going to get a steady return. And yes, there are instruments which give you for 10 years, 15 years. But reality is that you're losing the value, purchasing power of that money every time it's coming in. And you need to address that in your retirement years for sure. And that's what I've seen in my retirement plans, that as soon as you retire, you never see inflation have any impact for first 5 to 8 years. But after that, it just, there's a trough which happens. You just fall off a cliff.
Right.
Because suddenly you see that my expenses are too much and I don't have enough money left. So that's the biggest myth, that fixed deposits are an excellent investment for retirement. They're important, but if you don't supplement with other products, then they don't serve their purpose.
Okay. The next myth is market risk means मैं मेरा पैसा कभी भी खो सकता हूँ.
Well, I won't call it a myth completely because, there are people who have experienced that, right? So when does that loss happen, right? The loss happens is that you get into the market with a great expectation of return. So for example, somebody shows you past track record of an investment which has delivered, let's say, 14% per annum. So now you got into the fact that 14% is what I should expect. But unfortunately for you, you were in a period where markets tanked 25%. Now, nobody told you that this journey is going to be volatile. So interestingly, just to give you some very interesting data points here, if you do this analysis on the Sensex or Nifty, right, where you invest, let's say, we call it the rolling period analysis, that you take any time period of 1 year, right? So the Nifty started in 1995. So you'll have thousands of data points of one year each, right? And when you do that data and you analyze it, you'll see that if you hold the investment for 1 year, 50% of time you made money, 50% you lost.
Okay.
So today if you invest in the market, there's an equal chance of you making or losing money. But if you held for 7 years, right, you always made money.
Oh, wow.
Right? So that's why I said it's not a myth nor reality. Yeah, if you have a longer term horizon and you're patient enough, chances are you'll make money, and then it becomes a myth. But yeah, if you panic along the way when there are these great periods of volatility, then that's not a myth. It will actually happen that you lost your money because you panicked and you got out.
Right. Is this the thing about time in the market is very important?
Important, then that's why we say time in the market is important. And when we say market, it's a diversified portfolio. We are using the indices.
Right.
So suppose you bought an individual stock which is doing well today and say I will hold it forever.
May not work. Got it. The next myth is mutual fund सिर्फ young लोगों के लिए ही सही है.
In fact, mutual funds सबके लिए सही है, right? It is not just for young people. And so basically, when we talk of mutual fund, we think all mutual funds are investing into the stock market, right? But that's not the case. Mutual fund is saying that, look, you want to invest in a particular product, whatever your choice, I will just give you a professional service and simplify that for you, right? That's what a mutual fund manager does. And because they are able to collect money from so many people, they are able to invest not in just one instrument, but diversify your money. So just take an example here that you want to invest 50 lakhs into a bank deposit. You will probably put in one bank and forget about it. A mutual fund manager can take 50 lakhs from thousands of guys and ensure that they've invested in 10 different bank deposits. So if one bank goes FUD, you don't really suffer. So the diversification benefit is huge. So I would say that when you look at mutual funds, there are categories like fixed income, for example. So they don't invest in equities at all. The exposure to equities is zero, right? Similarly, there are gold funds, silver funds, for example. So you can actually, hedge the price of gold or silver by buying those funds easily. In the US, the largest category of funds invest into a product called REITs. So like you trade stocks, you can also trade properties, right, in that sense. So REITs actually the underlying is real estate. And all of us own so much of real estate, right? So I feel that mutual funds is just a conduit, and that's what makes it a great instrument, because you pick the investments that you want to make,
Right.
and here's of somebody who will manage it professionally for you, give you liquidity. Luckily in India, you also get some more tax breaks around it. So it's meant for all ages and all investors, right? So it's basically a service that makes investing simple for you. And all you have to really understand is, yeah, they cannot get away from the risks of the underlying
Right.
investments. Like if you buy real estate and it tanks 30%, when a fund manager buys also, if the real estate tanks, that will tank.
gonna-
But what they will do is they will not buy just one property, they'll buy 50 others. So hopefully you don't get caught out with the risk of investing in one single instrument. So it's meant for everyone. So that's a big myth that it's only for young people. And maybe I propagated the SIP story so much that many people think it's a way to generate
Right.
wealth. So for example, for active seniors, one of the best products to buy is something called a hybrid fund, because it gives you really exposure to all asset classes, or even a debt fund for that matter. And you use a feature called the systematic withdrawal plan, right? Where you say, okay, you decide the amount you want to withdraw every year, and the money keeps coming into your account every single month, like you get a pension check. So you create
Right.
your own pension through that product.
Right.
So yeah, it's meant for everyone. It's not just for young people.
Okay. So the next myth, Suraj, is that for active seniors, gold and property, these are the best investments.
Well, traditionally in India, we have bought a lot into gold and real estate. And at that point in time, it was not a bad idea, because gold and real estate inherently have beaten inflation over the long run.
Right.
So I never have, I would not take the value of that away from investing in these products. But reality is that, you want something which produces better returns significantly than what these instruments have given. You want liquidity. So financial assets have to become equally important. So one of the big trends in India is that, when you buy into mutual funds or you buy into equities through a mutual fund, whichever way you do that, you are able to hopefully generate a little better return than many such instruments. So I feel a good portfolio should have good weightages not only on your physical assets but also on financial assets.
Right.
And that could come through deposits, it could come through insurance products, it could come through any other financial asset for that matters. So yeah, it's a myth to think that gold and real estate is good enough. You need
Right.
financial assets as well.
Okay. The next myth is that I have a CA who manages my finances, so it's okay if I don't understand finances at all.
No, I don't think so. That's a great way, because ultimately, when you hire a professional, you have to have the ability to assess the professional, right? So also the kind of mandates you give to the professional, right? So if you don't have absolutely any understanding of investing, then whatever the CA does, or whoever your advisor is, you'll be left at the mercy of what they bring to the table. And in many cases, by the way, I've experienced that when they've done that, they've actually got into trouble. Because when they defined the mandate, right, they didn't spend enough time giving the right mandate to that professional.
Right.
And hence I believe that some basic level of understanding in investing is very easy. Actually, it's not difficult at all. So that you must do. I've been of the thought that there should be part of your curriculum in schools. You have to start that early in life, so that people know the importance of savings, how compounding works, what is equity, what is debt. So when you utter those words, you have a basic understanding how this is what they mean. So you may not be an expert at saying which stock to buy. You may not be an expert to pick which bond to buy. That's okay. But at least understanding that bonds are fixed income instruments, they come with fixed return, equities are volatile, so longer term works better, diversification works better, averaging works better. So these basic elementary stuff is very easy to do that.
Right.
In fact, with my kids, I ensured that when they turned 18, I made them write this AMFI examination. I felt that it covered everything. It was such a very basic kind of
Right.
stuff. And so today when I use any word, like for example NAV, they don't ask me what's an NAV. So it's like they understand, okay, this is the price at which you buy or sell through a fund. So it's
Right.
very easy for them to relate to. So yeah, it's a big risk you take when you don't know anything about investing and then go to a professional.
Right. Okay, awesome. So thanks for busting all those myths, Suraj. I want to come to a topic where I'll ask you a few different things. One is, if you were to recommend to a senior, let's say 5 habits or 5 things that they should do or incorporate in their daily lives, which can significantly contribute towards their own financial security, what would those be?
Yeah, no, that's a brilliant question, Mihir, and maybe this will be a little long answer, but please indulge me in it,
Sure,
because I think
absolutely.
it's something that will make a big difference. So when I've been doing this work on the area of retirement, what I've realized is that it's not about how long you live and how much money you have. It's about leading a life of purpose. So making your life worthwhile to live.
Right.
Right. And typically you will see that every element of that has an impact on your finances. So let's begin with very simple thing, your health. Right. Now, if your health is not good, then your medical costs go up. Right. So just imagine if you could stay healthy and you build a very simple habit of, going for a walk, sleeping well, having the right amount of diet, proper diet. It will really mitigate so much, risk on your life if you do that. So it starts with very simple things like that. So there's a very strong correlation, in terms of what you do otherwise on your finances. So I always believe that, so the way I really condensed all this thought was that I created this concept, so let me step back. So normally when you think of investing, because that's the topic that we took up today, in investing, what are you saying? You're saying that, okay, I want to generate a little better return without taking too much risk. So that I can fund all my expenses, right? That's all you start with. So most people think that retirement finances is about, okay, I've got a corpus, let me deploy it right. And where should I be investing? That's how they go about doing it.
Right.
But I realize that, what I call active income and savings are still as relevant in your retired life as they were in your working life.
Okay.
So what is active income? Active income is income that you earn from doing other things than investing. Like you were in your profession, right? So now if you become, if you're senior enough, you may become a director on a board of some company. You may set up your consulting firm. You may become a yoga instructor. So whatever your passion is, you can really build your life post-retirement around that passion, but you do some active income. Because every year of income or whatever percentage of your expenses you fund through that will have a great impact on your life. And now to earn active income, your mind has to remain sharp. You have to add value to society. Nobody pays you for free, right? So a lot of other things will fall in place just because you are now active even in your retirement age. So just to give my own personal example, when I gave up my corporate life, I decided that till I live, I will ensure that I earn my expenses. So I don't have to dip into my savings. That's how I defined. Now, who knows? Today, yes, I've been successful last 5-6 years to do that. But maybe at age 65, that may not be possible. But I'm okay even if I earn, let's say, 80% of my expenses. I'm okay even if I make 10% of my expenses. Because ultimately, I'm delivering some value to the society and then earning. And it has direct impact on my finances. For sure, even if I make just 10%, say till that age, I know I have to get 10% less corpus. And that's a significant amount that is required there. Similarly, people think savings is not important. Right. And that was the biggest, challenge I faced in my life that, should I give up savings? And the answer was no. I created this concept called the forever SIP, where I said, okay, till I live, I'll keep saving. And I shared the maths a little earlier that if you save 1,000 rupees every year for 30 years, depending on what return you generate, it will translate to that amount of corpus. So at 12%, for example, every 1,000 rupees that you save becomes almost about 25 lakhs. Now just imagine if I save 10,000.
Right.
I'll still create 2.5 crores in my retired life as well. So now what I do is I, use my SIPs, the forever SIP. The way I define is it's like an expense to me. So I do my budget for groceries and maintenance costs and insurance. I also put investments as an expense. So whatever my regular expenses are, I've increased it by 10%. So that 10% I continue to save, on a regular basis.
Right.
The only difference is I'm not adjusting it for inflation. As you go ahead in life, I'm okay even if I do the same amount for the next few years. So in real terms, it will actually keep dwindling down.
Right.
But if you can adjust for inflation, it can be brilliant. So I would say that that's the way you approach, that's what would be the key summary of my discussions today, that you have to lead a life which is purposeful, direct impact on your finances. And when it comes to finances, don't go ahead without a plan, because you need that roadmap to adjust yourself, and you'll see that as you do that, you'll feel so confident about leading a great life, because you're no longer dependent on anyone. Right, you have taken complete control of your destiny, so that becomes very exciting. And then when you create your portfolios, ensure you are diversified enough, right? So don't just get your biases take over and be equity heavy or real estate heavy. So if you have all the components in your portfolio, you've done a great job. So one simple thumb rule I give is that any asset class you think of, you should have minimum 10% in it. So imagine 10% real estate, 10% gold, 10% short-term debt, 10% long-term debt, 10% equity. You're set in life. Then you can make something 30, 40, 10. But minimum 10% allocation across can make a big difference.
Right.
And I'm sure life can be great fun if you follow these very simple tricks in life.
Awesome. Fantastic. So Suraj, if we had to summarize what we spoke today, we touched upon so many different topics. If we had to summarize this, maybe in a few bullet points, how would you do that?
So one of my favorite books which I read in life was titled The 5 Rules of Successful Stock Picking.
Okay.
Right. So let me give you the 5 rules for successful retired life.
Amazing.
Right. So first of all, I would say that stay healthy, because ultimately if you're not healthy, you're not going to, lead a great life. So whether it's your exercise, diet, sleep, that has to be top priority. Second is stay connected. Right. So if you don't have a social circle, whom are you living for? Right. So make friends, be close to your family as much as possible, but have somebody to live for. I always believe that's a great way to lead life. Third, live life on your terms. Right. I think it's enough living on for somebody else and somebody else's terms. Do that. Fourth, I will keep highlighting the need for a retirement roadmap. So always have a guidepost which can, guide you through those retired years. And fifth, stay diversified in your investments. If you follow these 5 rules, chances are you'll have a great life.
Amazing. Absolutely fantastic. So Suraj, thank you so much for, spending this time with us. I think the conversation we just had was like a treasure trove of information for anybody who's listening. And I can already see there are so many topics which we touched upon, but there is so much more discussion to be had on those. So I can already see us doing several more podcasts like this. So thank you so much for your time, and we'd love to have you back again.
It will be my total pleasure to be associated and share whatever little I've learned. And I certainly want that all your active seniors, have a wonderful life. That's my purpose now. That's how I have defined it. So I'm as excited about it.
Thank you so much. To our listeners, thank you so much for joining us. To know more about Suraj, you can connect with him on LinkedIn. His LinkedIn is Suraj Kaeley, that's SurajKaeley. He speaks a lot about all the topics we heard today, including the Forever SIP and several other topics. As always, thank you so much for joining us on the Meru Life Podcast. We look forward to connecting with you. As always, do follow us on Facebook, Instagram, LinkedIn, YouTube, all of these channels, and visit us on merulife.com. Thank you.